Welcome back to Dennis Bank Trades. This is episode 3 of our 20 video journey, as we had talked about. So this is Forex terminology 101, or the Forex lingo, the words that most traders are using. And if you really catching up with these words, you'll get to understand what everyone in the Forex community is talking about. So we have the pips, the lots, the leverage, the margin explained. Yeah, I'm sure you've heard about these words. So let's not take more time and let's dive in. Yeah, so what are we going to cover today? Why these terminologies matter in the Forex market. So pips, which is, we're going to look at pips, which is the unit of movement. It's very, very crucial to understand this. We're also going to look at lots, which is your trade size. As we look more into it, we're going to talk about leverage, which is the borrowed power given by different brokers. If you watched our previous video, you can actually now know who a broker is. Yeah, so this is a journey that we are taking from videos 1 to 20, which will take you from a beginner trader or an intermediate trader to a professional trader. Yeah, we're also going to look at the margin, which is the deposit that you make. We're going to look at the margin calls and stop out. So all of these are very important. So why terminology matters? So if you don't understand the language of trading, you can't understand the risk you're taking. Yeah, so for every business, you need to understand the layman terminology used so that you can actually relate to the different people. You know, trading is a learning curve. So the best thing you can actually do for yourself is to actually get to understand it from the basic. That's why I'm making these videos, these 20 video series, so that anyone can be able to understand it from the roots. So why this terminology matters again? To read the charts and platforms. So every platform speaks in pips, lots, margin. Without knowing this, you're flying blind. So every platform that we are dealing with, they are dealing with these terminologies every single day. We'll have the trading view, we have the backtesting softwares. So, and all that, like everything needs the understanding of these basic lingos. So to calculate your risk, so position sizing, leverage, margin calls are the math problems. You need the right terms to solve them. So in order to understand that for every decision I'm making, this is the amount of money I'm waging onto this position. So to understand the amount of money that you're going to lose or win in the market, you have to actually understand these terms. So without a proper understanding of these terms, you're bound to lose money. Yeah. So to communicate with other traders, you know, trading is not just charts as people think, but it's more. It's a community to fit in with other people. It's a constant journey of learning, you know. So in order to communicate and learn more and also interact with many traders to fit in, you need to actually relate to what they are saying. Yeah, so trading communities, YouTube, forums, all these use vocabularies. So you either understand it or get lost. So in order to be on the right side of things, you actually need to understand these basic terms. Yeah, so to understand your broker, whereby your broker will provide you with an account statement to show you how you've been performing. Remember, trading is a business for us professionals. So they'll give you an account statement whereby they'll have to show you the number of pips you've made in profit, the margin calls you've experienced and all that. So it's about actually understanding, even like, so this is the accounting side of your business. So the order confirmations, the margin notices, all are written in trading terminology. So in order for you to evaluate your trading business, you need to understand all of this. So I will start with the pips, which is the unit of price movement. So So a pip, you might be wondering, this is the smallest standardized move a currency pair can actually make. Yeah, so it can make the move down or the move up. Yeah. So a pip is the fourth decimal place in most currency pairs. So actually, when you see a pair with a price of 0.0001, so 1 is the pip. Yeah. So it is the standard unit used to measure how much a currency has moved. Yeah. So let's say you're predicting longs. So if it moves 20 pips, that's how much the market has actually moved. And if you wage a given lot size, as we'll see later in the video, in relation to the pips, you can actually know how much you're making. So pips are very important to understand. So here's an example. Euro USD is moving from 1.0850 to 1.0860. So actually, like when you see the difference is 10 points. But here in Forex, we call it pips. So it's a 10 pip movement. So in order for you to understand very well, you need to understand the basics. Yeah, so there's an exception of the JPY pairs. Remember, we talked about this in our first video, whereby we talked about the sessions, and in the Asia session, usually we trade the JPY pairs. Yeah, so there's an exception. So they use the 2 decimal places, unlike the one with 4. Yeah, so all of these you get to understand. Yeah. So there's a pip value. Yeah, so we have a lot type, the size, and the pip value, which is the approximate. So you have a standard lot. The size is 100,000 units, and the pip value, which we usually focus more, is $10 per pip. So let's say if you enter with a given lot, you need to know per pip how much is it moving. So if it's moving in your favor, it will be making $10 per pip movement. Yeah. So we have a mini lot, we have a micro lot. So all of these, you have to use them according to the amount of money you've invested. Yeah. Then we have the lot. I'm sure most of you have been hearing about this word, lot size, lot size. So they determine how much currency you buy or sell in a single trade. So a lot is a unit of measurement for trade size in Forex. So rather than specifying an exact number of units, brokers use lots to standardize order sizes. You get it? So brokers also use these lots. Yeah, like they will tell you how much you're waging against a given position you're believing in. So you have a standard lot with a pip value of $10. Mini lot with a standard pip value of $1. We have a micro lot with a pip value of $0.10, and then you have a nano lot with a pip value of $0.01. So standard lots are usually for institutional or funded traders, and these are usually operating with big accounts. Yeah, and also you as a person, if you're really confident, you've really learned from our YouTube channel, you can actually invest your money and these standard lots. There are no exceptions. Remember, as we said, Forex, you can make any amount of money in a day. Remember, this is a 7.5 trillion market that's traded daily, so you can actually make an infinite amount of money. Yeah. Then for intermediate retail traders, you can actually use a mini lot. Then for beginners, yeah, so if you're just beginning, yeah, remember also, yes, you can make the money, but also we need to use risk management. You can act as much as you can make the money, you can also lose the money. So that's why at Forex Bank, at Dennis Bank Trades, we're actually taking the initiative to actually teach you from zero to understanding the business. So for beginners and small account, you're most likely to use micro lots. Then we have a nano lot, which is for practice and cent accounts. Yeah, so if you're just beginning your niche and all that, yeah, it's better you use that. So as a beginner, you have to start with micro lots. Controlling your lot size is one of the most powerful tools that you have. So we talked about leverage and our previous video, and you haven't watched it, yeah, it's on the channel, the second video. So leverage is borrowed power. So it amplifies both your profits and your losses. So as much as you can be right, you can also be wrong through the same leverage according to your prediction. So it's how fast you're making the money and also how fast you can lose the money if you're wrong. Yeah, so leverage, it lets you control a larger position than your actual deposit. A broker is lending you leverage. That means that you can trade with capital you don't physically own. Yeah, so if you actually paid attention to our broker's video, you can actually now relate. So how leverage works, this is an example. So let's say your deposit is $1,000 and your leverage is 1 to 100. So that means that in this position, you're controlling $100,000, which is the standard for the actual market. You get? So for the 1 pip profit, you'll be gaining $10. And and if your direction is wrong or bias is wrong, you'll be losing $10. So the most common leverage ratios, we have the 1 to 10, which is the conservative, whereby it will amplify your amount by 10. Then we have the 1 to 30, which goes under these regulatory bodies, as we talked about, the FCA, SCIC. So they regulate up to this leverage or more. Then we have the 1 to 50, which is the moderate risk. Then we have 1 to 100, which is a high risk. Then 1 to 500 plus is the danger zone. And as we saw in our second video, most unregulated brokers would and as we saw in our broker video, most unregulated brokers will give you actually more than 1 to 1,000 leverage, 1 to unlimited. So yeah, that is also a key take. So the leverage amplifies losses just as much as profit. That's why most traders call it a double-edged sword. Yeah, so high leverage on a small account is the reason beginners blow up. Yeah, so as a beginner, as an intermediate trader, as someone who is just appreciating Forex, actually, this is very important for you to learn. Now we have the margin. This is the deposit required, and it varies broker to broker. So margin is not a cost, it is a collateral your broker holds while your position is open. As I said, brokers are just intermediaries. So in order for them to help you open a position, they must have some collateral. So that is the margin. So margin is the amount of money your broker sets aside from your account to open and maintain a leverage trade. So this is calculated as a percentage of your full position size. The margin formula here is trade size divided by the leverage. So here's a worked example, as you can see. So if the trade size is 100,000 units, which is one lot. So and we also have our leverage, which is 1 to 100. So actually, when you do the math from our formula, you so 100,000 divided by 100, you have 1,000. So that means that the free margin, this account balance minus $1,000, and you have the given figure. Yeah, so there are also many margin types, and here we managed to look at the required margin. So it's locked to hold the trade open. So without this margin actually being available on your account, the trade will close. So this is just the required. So we have the used margin, which is the total locked across of all open trades. So if you have many running positions, now this one is locked for all. Like, in order to maintain these trades to be running either in your favor or not. Then we have the free margin, which is available to open new trades. Let's say you've learned how to do market analysis, and let's say now these trades are running in your favor. You can actually add in more positions. So if you have free margin, you can actually open new trades. So we have the margin level, which is actually calculated as equity divided by used margin times 100%. So when you open up either a demo account or a live account, you can actually see all of these. Yeah. Now we have what we call a margin call and a stop out. So all of these, they are enforced by the broker in order to protect your money. Yeah. And for some unregulated ones, it might be manipulative. Yeah. So the two danger levels every traders must understand before going live. So remember, at Dennis Bank Trades, we are here for the education so that your money is protected. So what is a margin call? I'm sure many of you have really heard this term from maybe TikTok or from maybe a friend. So margin call, this is triggered when your margin level drops to 100%. Yeah. So let's say you're in a position, a buy position of, let's say gold or XAUSD as some people call it. And now it is running against you, it's dropping. So by the moment this position is running against you, you're actually losing money. So when the money drops to actually like 100%, so when the money runs to a depletion of 100%, then there you get a margin call. But this is triggered, when your margin level drops 100%. So what really happens is that you get a broker alert. So you can add funds immediately to hold your position, or if not, you can actually lose the money. Non-news trades can be opened. Yeah, so actually, when these news, remember, a news event is an uncontrolled event in the market. So usually here they can protect you by giving you a margin call whereby you won't be able to enter positions. Yeah, so this is done because actually you can actually lose a lot of money because it's an uncontrolled event in the market. So if existing trades are still open but at risk, so if you opened many positions and your margin is all used up, you can't actually add in. So if you try to add in, they will give you a margin call. So if you ignore it and stop out follows. So actually, let's say you've risked $100 and $100 is what is on your account, you can actually get that margin call. So also, what is a stop out? So this is triggered when the margin level drops to 20 to 50%. Let's say you had 10 standard positions running and now the price is moving against you. Now here actually you would get a stop out whereby you realize that some of the trades have been cut out. So this is done in order to protect your account. So broker auto closes your largest losing trades, as we've said. So continue closing trades until level recovers. So if you go into the profits in accordance to your prediction, then you can add in more. So you have no control, it's automated. So whereby it will just happen if you have losing positions. You can lose most or all of your deposit. So remember, by the time you open a position, you have to be really like having that mindset that you're either going to lose or you're going to win. Remember, and this will be covered more into the trading psychology, so stay tuned in. Whereby we'll be talking about the mindset like every every trader must have in order to succeed in this market. So how to avoid both? So never risk more than 1 to 2% of your account per trade. Always use a stop loss. Monitor your free margin daily. Yeah. So all of these are profitable or professional trader behavior. So the quick reference. So bookmark this. You come back to it often. So we have a spread, which is the difference between the buy and the sell price. So this is your broker's fee. If it's high, you're not making that money. If it's low, meaning your broker is favoring you. So we have a short, that is selling a pair exchange, selling a pair expecting the base currency to fall. We looked at this in our first video. So we have what we call a swap or a rollover. So this is the interest paid or received for holding a trade overnight. So you will experience this also. Let's say you've been holding a sell position, and for every night that passes, let's say that exchange from midday to, let's say, 1 a.m., the broker will actually charge you what we call a swap fee. Yeah, so we have the ask price, which is the price you pay to buy a currency. Then you have the balance, which is the total funds in your account. Let's say if you have $500 and then you're in profits of $300, your balance is $500. That $300 is not realized until it's closed. So if it closes, that means that your balance will be 800. Yeah, so we have a stop loss, which is an automatic order that closes your trade if price moves against you. Then you have bid price, which is the price you receive when you sell a currency. So ask is for buying, bid is for selling. So you actually see all these terms when you open up an account, a broker account. So we have equity, which is the balance plus unrealized profit. Yeah. So this, as we talked about the other example, so if you have $500 as your balance, you open your trade and you're floating $300. That means that $300 plus $800, that means that you're $300 plus $500, that means that your equity is $800. So it is the summation of your unrealized profit and the balance. So you have the take profit, which is an automatic order that closes your trade at the profit target. So let's say you say you're buying an iPhone at $500. So when it actually rises to $800, so you set $800 as your take profit. So when the price of an iPhone reaches $800, that will be your profit. It will stop out automatically. Then you have a long, which is buying a pair expecting the base currency to rise. Then you have drawdown. This is the peak to trough decline in the account value. It measures risk. So let's say now you opened up a position of $100. So if it's a buy, right? So if you entered, let's say at let's say $1.5, that is the price that you entered, or 1.15, okay, 1.5 points. So, and you're saying the price is going to rise to 2. So anything below 1.5, the points that you predicted, that is a drawdown. So you'll be seeing that loss, unrealized loss. So if it goes past 1.5 points of your prediction and it's moving towards 2, then you start seeing profits. So we go more into that, don't worry, in more videos to come. Then you have a slippage, which is the difference between the expected and the actual execution price. So this actually happens in news. Yeah, so news trading, you have to be very careful. So in layman, slippage, let's say your stop loss was at 1.5 points. Yeah, and now you find out that, let's say that was your stop loss. So you find out that your broker put your stop loss at 1.3. So you've been slipped 0.20 points. And this usually happens in uncontrolled environments such as news trading. That's why if you're new, you're not advised to trade news. So this is a lesson recap. What we learned about a peep value, lots, leverage, margin call, high leverage. So you can actually watch this video again and again until you actually understand. So up next in our 20 video series, as we promised here at Dennis Bank Trades, so we are going to look at how to set up a workspace, a trading workspace. So we're actually now moving away from the theory to actually setting up a physical workspace whereby you can actually make money. So we are going to talk about the trading view setup, walkthrough, a broker demo tour. We are going to do chart layout best practices. We are going to talk about the indicators to add. So just stay tuned in. Just stay tuned in for our next video. Yeah, like, comment, subscribe. Yeah, just share this video to a friend. Comment anything you want us to talk about in these coming episodes and all that. Yeah, stay tuned and stay blessed. Yeah.